Good morning, everyone. Welcome to the Teachers Retirement System of the City of New York Investment Meeting for March 1st, 2018. Patricia, would you please call the roll?
John Adler.
I am here.
Thomas Brown.
Here.
David Bazansky.
Present.
Deborah Penny. Here. Raymond Orlando.
Not here. He's hopefully coming later.
Susanna Vickers. Actually here. Okay. We have a quorum.
Thank you very much. And I'll pass it over to our friends from Rokaton to take us on the reporting.
Great. Good morning, everyone.
Good morning, Mike.
So we thought we would start off by just very quickly reviewing 2017 now that the fourth quarter reporting has been completed. So I'm in the larger book. And we don't have to flip pages, but what I was just going to note was the performance for each of the passport funds for the 2017 calendar year. So the Diversified Equity Fund, with the strong returns in the markets we saw last year, that fund was up about 21.1%, roughly in line with the return of the Russell 3000 index. As you know, the fund also includes allocations to non-US equities and defensive strategies. The benchmark we use, which include those asset classes, was up about 21.8%. So while the fund was in line with the broad US market, it lagged a little bit that hybrid benchmark.
Do you want to make the 5-year number?
Yes, worth noting in particular, the 5-year number for the Russell 3000 index was up about 15.6%. So even when you look out beyond last year, really strong numbers for the last 5 years in particular. So during that time period, the overall fund returned 13.4%. So still a strong return, though somewhat lagging the U.S., which over that longer term time period, you'll recall, did continue to outperform non-U.S. developed and emerging markets. And so that allocation within the diversified equity funds, it might have helped you last year, but over the longer term, that 5-year time period, the fund lagged the U.S. because of that. And when you look at the different components within the diversified equity fund, the defensive composite last year, even though it didn't keep pace with the U.S. equity markets, was still up about 14%. So you saw the defensive composite really capture a lot of that upmarket, more than 3/4 of that upmarket that we saw in the U.S., which was certainly favorable. When we look at the international portion, last year, the international portion or composite of the Diversified Equity Fund, that was up about 27% last year, and that was enough to outpace the custom benchmark you have in the international equity space, which was up about 26.6%. So again, these are very large numbers, and why in the first meeting of the year last month, we talked about, again, some of the concern that we approach a market when we see numbers that are so stark and so positive. I think it was probably the day after the meeting in February that the market volatility really picked up, and where we started to see some more interesting numbers that we'll talk about for sure. Maybe very quickly, I'll comment on the other passport funds. So Variable E, you'll recall at the end of last year, began to undergo a transition to the balanced fund. So we weren't going to comment on the total performance of what was the bond fund, just given that it wasn't technically a full year's worth of performance. But what I will comment on are the other passport funds. There's information on those beginning on page 13. And really what I'd highlight there, as I mentioned before, the international composite. With the international composite, the overall international fund was up about 26.8% last year. Outpaced the custom benchmark, which was up about 26.6%. I commented earlier on the 5-year time period for the Diversified Equity Fund. If you look at the 3-year number for the International Equity Fund, that fund was up about 9.5% over the last 3 years, roughly in line with the custom benchmark. And though it's not on page 13, I'll comment on the International Equity Fund's 5-year number, which was about 8.6%. So again, really strong numbers over that long 5-year time period, relatively longer 5-year time period. The Inflation Protection Fund during 2017, that was up about 4.1%. That was enough to outpace its custom benchmark, up about 3.1%, and inflation last year. Inflation last year was up about 2.1%. Over the longer term, that fund's had more muted performance. The fund as a whole has been up about 1.6% over the last 5 years. That's enough to outpace its custom benchmark, which was roughly a flat return over that time period. And CPI over the last 5 years has averaged about 1.4%. The socially responsive equity fund, last year that fund was up about 18.3%. Compared to the S&P 500, there was some relative underperformance there. The S&P was up about 21.8%. So while the socially responsive fund did keep up with the high double-digit teen returns, it didn't quite keep pace with the S&P 500. Over the last 5 years, that fund has returned about 14.7%, and that's lagged the S&P, which has returned about 15.8%. So I'll pause there and see if there are any questions on how the funds have done over the last year and longer term. But we can dive in to the more recent numbers.
Can I just make one comment? If we flip back to page 3 and just focus on some of these numbers, particularly for the U.S. equity market. So you've heard a lot of numbers from Mike about the fund and the passport funds and their benchmarks. But we are going to have a discussion about smart beta strategies today, and there's going to be another discussion about smart beta tomorrow. And part of the rationale for the smart beta discussion and and the premise really behind BAM's interest in adding these strategies to the pension fund is the question about what level of risk are we taking on at this point in the cycle in capitalization weighted benchmarks. So the S&P 500, the Russell 3000 are capitalization weighted benchmarks, meaning the largest cap stocks have the biggest weights. And if you look at some of these numbers, for the Russell 3000, for the S&P 500, average returns of close to 16% for the last 5 years. Fairly high PE ratios. Yes, there's economic growth, but we've had pretty sustained, above expectation returns. And at some point, this is going to turn over. And we have no crystal ball, no one has a crystal ball, and it's not clear whether it'll turn over abruptly or whether there'll be just a slow degradation of returns. But this level of return is clearly unsustainable. And so that's why we diversify into things like non-US and emerging markets, but also into strategies that aren't capitalization weighted. So one of the bases for actively managed strategies, and which smart beta is a category of actively managed strategies, is that the capitalization weighted benchmarks have done so well, and over this time period better than most managers in most style categories, that maybe we should be looking at something a little bit different for the next 3 to 5 years, because it may be the case that these largest cap stocks are so fully priced that the expected return going forward over the next 3 to 5 years may be lower than we want. And I think for our outlook for the 10-year period, our U.S. equity outlook is
4.7%.
So a little bit under 5%. So the smart beta strategy, all of the active management recommendations are based on the premise that U.S. equity returns are going to be lower over the next 5 years, or likely to be lower over the next 5 years than they were over the past 5 years. And can we do something even around the edges that marginally improves that single-digit return?
Okay. Any other questions or comments on the performance report? Do you want to talk about February for a minute?
So maybe let me spend 2 minutes just on January.
Oh, sorry.
And then
Let's just enjoy the moment.
So as you'll recall, when we were here last month, we talked about January markets continue to be gangbusters. The U.S. equity market as a whole was up about 5.25%. The Diversified Equity Fund during the month of January was able to keep pace to the tune of about 5%. So another strong month on the heels of what's been a very strong environment, as we've discussed. What contributed to the 5% returns? Well, there were strong returns in non-U.S. equity markets as well as U.S. equity markets. Both of those contributed to the performance of the Diversified Equity Fund. The Defensive Strategies composite also was up about 3%. So while that detracted a little bit from the relative results of Variable A, that certainly positive performance there was certainly helpful. Taking a step back and we look a little bit at some of the other funds, you can see the Balanced Fund, which was one of the newer fund, which was the new fund that launched at the beginning of the year. That was up about 1.26% in the month of January. The International Equity Fund up about 5%. So again, really strong returns. The Inflation Protection Fund market there was a little bit softer in January. You'll recall that fund holds a variety of asset classes, including commodities, bank loans, TIPS, real estate securities, and so there the market was a little bit more mixed with a modestly positive return of about 0.17%. And then finally, the Socially Responsive Equity Fund, that was up about 5.5% in January, whereas the S&P was up about 5.7%. So we got the year started off on the right foot, and then it was beginning, I want to say the first day of some really noticeable market volatility was February 2nd. So you might recall hearing big headlines with regard to the VIX blowing through what would have been, really quiet levels for quite some time. And if it was interesting, there was a lot going on in the first 2 weeks of February. And then if you had, let's say you fell asleep at the end of last year and woke up in the middle of February, it would have been as if nothing had happened. So it was very interesting to see what were, down days to the tune of 3, 4, or 5% in some markets. But at the end of the day, if you looked back at the beginning of the year, there wasn't much to write home about. So this report, which the preliminary report, you'll note that it's actually through Tuesday. But I'll comment a little bit on how yesterday impacts this. And the main takeaway was yesterday was a down day to the tune of about 1% to 1.1%, depending on which market you looked at. So through Tuesday, the U.S. market was down about 2.6% month to date in February. I figure about 3.6%. But if you look at calendar year to date through Tuesday, the market had already been up or continued to be up about 2.5%. So take about 1% off of that number. The Diversified Equity Fund, which obviously includes U.S. and non-U.S., and that Defensive Strategies composite. The defensive we would have expected to have certainly helped protect in February. Through Tuesday, we're showing a down number of about 1.9%, so providing some of that cushion on the downside. Through Tuesday, the Diversified Equity Fund would have been down about 2.8%, and perhaps perhaps a little bit higher because of the down day yesterday, and hopefully the defensive continued to protect yesterday as well there. Calendar year to date through Tuesday, the Diversified Equity Fund would have been up about 2.2%. So again, you could adjust that a little bit in your mind for another down day in the equity market yesterday. What I'll highlight here is the Balanced Fund benchmark, which you'll see was down about 1.1% through Tuesday, and roughly flat year to date through Tuesday. Developed equity markets, the MSCI EFI market, you could see that was down about 3.8% in February, with a calendar year to date return of positive to the tune of about 1%. That's probably more like 0 or flat today, through yesterday rather. And emerging equity markets were actually down about 2.8%, so a little bit less than developed markets so far in February, and a more positive return year to date of about 3.4%. EM was also down yesterday by about 1.25%, so you can haircut that one as well. So are there?
Yeah, I have a question, Mikey. You had mentioned how, at the beginning of February when things were happening, the VIX was going crazy, and now where's that or other indicators? As
Yeah.
stuff becomes more volatile, what's happening with those other indicators?
Yeah, so the VIX continues to be at an elevated price level. So
Steadily?
it's not, I wouldn't say it's at an increasing price level. It got to a point where it increased, and then the way it typically trends is that it spikes up very quickly and then sort of tails down.
But it's at an elevated level relative to a very low
Right,
level.
where it's been for the past couple of years.
Yes. So it's moving back into more typical levels, historic, if you look at longer term history.
Thanks.
I just have a question about CPI. So the January report shows CPI up 54 basis points, which is a lot for a month. And I don't know if you know but is inflation seriously, like, I know interest rates are rising. Is inflation going up like that kind of number?
I think it's something to do with the way they every time they report a return, they annualize it. And so I have a feeling
So that is an
it smooths
annualized?
out. Yeah, that might be the annualized level.
No, inflation is running about, CPI is running about 2%.
2% annualized. That
Might be a season.
That might, well,
We
this
can
is seasonally adjusted, for all urban consumers. So
That's okay, whatever.
but
Any
it's probably a 0.5% on the 2% is what you would see.
I don't know what that means.
What does that mean?
So if CPI runs at an annualized level of about 2%, the mark in January increased by 0.5%. So 0.5% on 2%.
So it's running at 2.5%?
No, not. It's a percent of a percent.
Oh,
not,
okay.
No, you're not adding the percent.
0.5%,
Yeah.
2% is like
Yeah.
nothing.
Yes.
Yes.
Yeah.
Okay. All right. Any other questions, comments? Great. Thank you. All right. So now, next item is the divestment policy.
Okay, so everyone should have a copy of the post-final policy in front of them. I'll point out one change since the document was distributed, I believe on Monday. And this is just I think it tightens the policy. It's not a substantive change in the sense of what the board was intending. So it's in the scope section, as you'll see, and it was to address a point that John raised, that some of our, what we would consider public market managers or managers where we control the investment guidelines, they can hold private security. You were talking particularly in the high yield area. So this just reflects that those agreements, those types of relationships with managers would be covered by the policy. That's all this change is intended to capture.
I just want to give an example, particularly for Susanna. So, for example, this board has divested from gun manufacturers. And there is a very large gun manufacturer that is not publicly traded, which is formerly known as the as Freedom Group, but now called Remington Outdoor Company. And it's owned by Cerberus, a private equity firm. And it is possible, and I don't know this for a fact, that company issues publicly traded debt that high yield managers could buy and own. But it probably doesn't appear on the list of specific securities that we exclude from our portfolio. And so I think we want to be clear that we want to exclude the securities of those companies as well, even if they're not publicly, even if the equity is not publicly traded, but they may have publicly traded debt. So I think that's something we actually want BAM to look into for our existing exclusions.
I believe that they did look at debt issuance of gun manufacturers
They
as well as publicly traded equity.
For high yield, for example, to ensure.
I don't know
Because,
what
you
was
know,
written
that
into the
list-
guidelines, but the
Yeah.
list
Right.
included debt securities as well.
Well, it says debt securities, but the list of companies,
Yeah.
I don't think includes privately owned, like Freedom Group / Remington Outdoor Group.
Okay.
Freedom.
Check.
Yeah,
Yeah, we can double check.
yeah. Let's check that.
And-
And there may be instances in other industries, like that's one that you know I know about. I mean I looked at it, thinking about the high yield, since we're doing high yield tomorrow, and there may be coal companies, there may be other privately owned companies in industries that we have divested from that we want to ensure that they don't show up in our, you know, in any of our publicly traded debt portfolios.
And I think with some of our new systems, we're able to kind of take a deeper look and slice it and dice it in
Yeah,
that
that
way.
would be good. Great.
If I could just reserve the right to come back to this.
Sure.
If, you know, like I think we should try to move ahead with discussing and maybe approving the policy. But if for some reason Scott Evans, or if this, you know, affects high yield, Wesley has a question, we might have to come back to this point.
Okay, yeah, so this was on for discussion today. The idea would be if everyone is comfortable with the policy, we would bring it to the board meeting.
Okay.
Later this
So,
month.
but
Right.
the regular board meeting. If between now and then you had any concerns with this, by all means.
Right, and maybe we could talk about it tomorrow if there is.
Okay.
Thank you.
Anything else on the divestment policy? So let me just ask, typically we would, at the investment meeting, see if there's consensus and then recommend it for action at the board meeting. Should we hold off on that, given that this is a new little change that one or more trustees might come back with comments on, or should we go ahead and do that pending, you know, leaving trustees the right to come back in advance of the board meeting? What's your recommendation?
It's up to the board, but I think you could have a consensus
With that caveat?
with that copy.
Okay, so let me see, is there a consensus with that caveat?
Yes.
Okay, great. Terrific, okay. Thank you for all the work on this. I want to thank both Susanna and Valerie and the other trustees as well. Okay, I think that takes us to our educational topic for today and tomorrow. And we better be very smart about smart data by the end of the day tomorrow.
Absolutely. So I think everyone has a deck, and that this is the same deck that was emailed to everyone. So the reason we thought it might be useful to talk about smart beta and factor investing as an educational topic today, well, a couple of things. One is I think it fits into what we're trying to accomplish, at least part of the agenda for these meetings, which is to talk about something that's that is a topic of interest to large institutional investors, and that is being pursued by at least some large institutional investors, in which the board might be interested in learning about. And secondly, because this deck focuses at a higher level in discussing smart beta and factor-based investing. Tomorrow, I think what you'll see in Bam's presentation is more of a focus on implementation alternatives. And so what we've tried to do today is to talk about smart beta as an active management strategy and what are the pros and cons of the concept and why are some investors embracing it and others not embracing it. So that's the perspective that we're approaching this discussion with today. The thing that I wanted to say that I think is the most important thing to note is that factor-based investing, also known as smart beta, is a newer buzzword, but it's active management. It is really another way to pursue active management. And factors are simply, in equity markets, are simply sources of return for the market. And every active manager you hire, or have ever hired, uses factors in their portfolio construction. So we hire value managers. They're using value as a factor. Value is a factor that you can buy in smart beta, but you have managers that focus on value factors. You have managers that focus on momentum. You have managers that focus on earnings growth. So every active manager selects securities using a winnowing approach that identifies factors that they're interested in, and then they try to find the best companies that display those factors. And they build a portfolio. And that's what factor-based investing is. So, yes.
Well, but you would say that active managers use factors.
Yes.
But you wouldn't say that all active managers are smart beta.
No.
Right.
So what the...
You could say all smart beta is active, but you wouldn't say all active is smart beta.
Yes. So what does smart beta mean, aside from a catchy product name? Smart beta means that managers are using quantitative methodologies to select securities that display certain factors. And your active managers are using fundamental research methodologies primarily to select companies that display certain factors. So there's a lot of similarity across traditional active management and these smart beta or factor-based investing strategies. The factor-based investors would say they are pure because they're focusing very explicitly on these factors. They're lower cost, so their fees typically are between traditional active managers and passive managers. And they're more systematic because they're using quantitative methodologies, and they're less influenced by stories about management or stories about new products. They're really focusing on characteristics that these companies display rather than the stories behind the characteristics. And I think that's really lost in a lot of discussion about factor-based investing. It's just a more quantitative and systematic approach to investing, and is very similar in many ways to traditional investing that we've all become familiar with over the past several decades. So Mike is going to talk a little bit more about the details.
Yeah, that was a good introduction, but maybe I'll start by talking a little bit about what we mean about beta. And so when people throw around the term beta more generally, they're referring to market beta.
Yeah.
Or the sensitivity of a stock or a group of stocks, sensitivity to how the market moves as a whole. And you can call market, or that broad movement of the market, that in itself, you could call that a factor. That is a factor. So you could look at the sensitivity of your portfolio to how the market moves. And you know, the expectation is if that the market goes up 1% and you have a beta of 1%,
A beta of one.
a beta of 1 rather, your stock should move like the market. Now, what factor-based strategies are doing, they are essentially assigning a factor weighting or a factor score to different companies based on different betas that go beyond just market. So maybe slide 4 is one way of illustrating this. So there's been a lot of academic research around factors, and I actually, Mel sent me an interesting article the other day that noted there were at least 300 published factors by academics. So it's really interesting to see how many times and different ways this can be sliced and diced. But some of the more popular academic work that was done in this space was done by Eugene Fama and Ken French in the early 90s. And what they were trying to do was they were trying to take beta and disaggregate that into different factors. So how much of the return of a stock or a group of stocks can be attributed to other things outside market? How much of it can be attributed to the size of the company? How much of it could be attributed to how the company trades, or what's the valuation of that company on a relative price, stock price to earnings metric? How does the company compare to peers on a quality basis? And usually what they say then in that regard is on a debt to equity ratio, how much leverage does the company have? And then one of the other popular factors that comes up quite a bit is momentum. So for stocks that are rising quickly, can you find some credence in their ability to actually produce better when they're associated with stocks that are moving more quickly? So there's a number of factors, and what smart beta or factor-based strategies are doing is they're trying to score or assign some weighting to all of these factors for each company rather, in the universe, and as Robin said, apply some systematic process to reweighting portfolios based on these factors. And so when you talk to one of your traditional active managers, they might say, yeah, factors are important, but we don't care about factors. They'll say, you know, we meet with companies, we like to talk about products, we like to talk about management, we think management's very important. So we're not concerned with whether or not you think a company is a growth company or has a lot of debt. We're not concerned with how a factor score impacts our portfolio process. We're picking companies. But when you dig a little bit deeper and you talk to managers about what their process entails, their process usually entails, as Robin said, focusing on certain aspects of the company's financials, certain aspects of how the companies conduct their business, who their peers and who their competitors are. And you can use that information to look at their portfolio and understand what are the biases associated with active managers. And so in that regard, they are also using factors to come up with how they view companies, how they construct their portfolios. It's really embedded in their philosophy. They just won't say at the onset that they're doing it that way. And not to say they're trying to hide, but they don't think of it that way. That in a lot of cases, for them, it's about trying to exploit some of the idiosyncratic things that they can find in their research process. But if you look at any portfolio, you can take the stocks in the portfolio, you can assign factor exposures to any portfolio using a quantitative process and using different factors that have been published in academia, and understand what's my exposure to value, what's my exposure to momentum, and you can understand how the manager's performance has sort of been driven by those factors. So I'll pause there and see if that resonates or if there's any questions.
So would it be fair to say that with factor-based investing, they're basically putting on blinders? They're forgetting about all this other stuff that other folks may look at and just saying, these are the categories that we care about, nothing else matters? Or do they primarily say that, but also kind of weight some other stuff? Or is it just a very narrow vision of just these issues?
They try to take all the subjective and behavioral aspects of the process out of their methodology by doing this very systematic, usually a computer quantitative oriented way.
So it's a very, very focused process. They're not meeting with management. They're not looking at new product introductions. They're really trying to understand what has driven this company's stock price movement historically, and whether they think that there is persistent incremental return associated with that factor. So the academic research has stated, among other things, that over time you get rewarded for having a value exposure. Over time you get rewarded for having a quality exposure. And what a factor-based manager would say is all of the other stuff is noise. And it's nice if management is good, but what really is driving the stock is the sources of return for that stock.
Right. Well, but then wouldn't it, I mean, then isn't every factor that they're looking at ultimately just, as we call it, past performance? Because they're not trying to glean any information about what may happen in the future outside of what has already happened in the past.
So I think where the discussion does go further, to your point, is you have managers in the smart beta space who, what they'll do is they'll construct portfolios of multiple factors, and they'll use that what they'll call their multi-factor model. And so they'll be cognizant of their exposures to all those factors, but they'll also take into account how those factors are priced relative to history. So they might make a determination in their portfolio that today value is very underpriced, and I would want to overweight my factor exposure to value and potentially away from momentum. So if momentum has been really strong, which many would say, especially in the tech space last year, you saw companies up 30, 50%. Those companies would have had a higher momentum score. Okay, maybe that's not sustainable. And so as the smart beta manager, I can use all this information to make some judgment about how I could tilt my portfolio in a way that might be better positioned to take advantage of some of the relative values between factors.
So they are looking at historical data to understand the factor exposures in the portfolio, but they're looking forward to understand whether that factor is attractively priced today.
Oh, okay.
The thing about, don't many managers offer many factor funds? So in
Yes.
other words, BlackRock has, I don't know, dozens, scores, hundreds, I don't know what the right
I don't
number
know
is.
what the number is either.
Right, of different factor funds.
Yes.
Single factor, multi-factor, whatever. And so the manager's not necessarily making a call on which factor is the best factor. And they may, and in some ways, I think what they're saying to investors is, here's our deck of factor funds, you make the call. What was that? There used to be a TV commercial, you make the call.
AT&T.
Well, who was
Is
it
that
for?
AT&T?
AT&T, might be right. Here's you make the call factor. No, it's just.
Or you can cover all of your bets by investing in all of them.
Well, which is what an index fund is,
Yeah.
truthfully.
Yes.
It's March.
What's that?
It is March.
Yeah.
That's the volume at the call.
Yeah, right. But then I imagine that there are some more active. I mean, those are really passive factor funds, I think. I mean, I know that's a little bit of an oxymoron, but as you say, I think they're low cost. There's also ETFs, factor-based ETFs.
Yes. So it's really interesting. So there's a lot. If you watch at all any of the financial press or anything, there's a ton of money being spent on marketing factor-based strategies and smart beta. And so the index managers like this a lot. The index providers like this a lot. So index providers, I mentioned before, 300 plus factors. I also saw a snippet that one of the index providers itself offers over 4,000 different factor indices. So I don't know that there's a product for every one of those indices, but there's certainly an incentive to proliferate the creation of indices that become licensed by asset managers and asset managers who turn around and then market product, because it could be a very quick asset grab. And even though the fees are not as high as active management, traditional active management, they're definitely higher than if you went out and bought a capitalization weighted index fund.
What's the order of magnitude of it, if you can? Like, in other words,
For fees?
yeah, a typical, and I'm sure there's a difference between, I know we pay virtually nothing for the capitalization weighted
Yes.
index funds, but a typical investor, is going to pay, a typical institutional investor is going to pay, single digit basis points, I think, for a U.S., a Russell 3000 or an S&P 500.
Yeah, so it might be double the mid single digit, and then figure active management could be anywhere like 10 times that.
So there are some very active managers. I'll throw out one name, like AQR, who manages factor-based strategies.
Who?
AQR.
AQR, right?
Yeah,
Right.
manages factor-based strategies, and they certainly have reasonably high fees. So they're in every case they're higher than capitalization-weighted benchmarks, but it depends whether they're actually providing any discretionary management. So
Right.
the index, there are passive factor-based strategies that are still higher fee than capitalization-weighted indexes, and then it goes up from there.
So,
And just one other thing. So there are there are proliferation of products. What the multi-factor managers do is they select factors and they reweight factors based on how attractive they think any factor is in the market at a given point in time.
Oh, so they are, in other words, not, the fund isn't advertising that we're 30% momentum and 40%. In other words, they say, here's the factors that we utilize.
Yes.
And then based on market conditions, we're going to overweight or underweight various.
Exactly.
I see.
Exactly.
So that is totally active management.
Yes. Yes.
Yeah, I would say to some degree, I shouldn't even say to some degree, to a large degree, there are active managers or smart beta managers that are coming up with ways that they think are an improvement over how the traditional academics have identified factors. So if we think they're defining value in a way that's not as good as the way we can do it, we try to exploit that as well. So there's active management in the way they define and build the factor as well. So the AQR would be an example of a firm that does a lot of research around that, and they incorporate that into many of their strategies, not just the factor-based strategy.
So it might be not, in other words, the value may not be based on traditional price to earnings, it might be priced to something else.
Right, is it priced to, yeah, or is it priced to 5-year earning, 5 years past earnings, 5 years projected earning? There's a whole, the timing of when you line up which price and which earnings report you're looking at. There's a lot of different ways of looking at it.
Right, okay.
So, we have a lot of information in here, and you are going to hear about this tomorrow, but I think the most important takeaways are this is active management. You're going to pay higher fees. And the premise for this is that by systematically identifying and investing in attractively priced factors that drive market returns, you can generate better returns after fees than a capitalization weighted benchmark. That's the theory. One of the challenges to investing in this area is that there are relatively few products that have a long record. It's a pretty new field. There's a lot of academic literature that says over long periods of time, certain factors like value, like small size, yield incremental returns, that you get paid for taking that risk. But it can take a long time to realize those returns, and they don't always incorporate all the trading costs and other costs associated with those investment strategies. So as with the evaluation of any active management strategy, you have to bring a fair amount of skepticism. You have a strategy that has performed very well at pretty close to zero cost in terms of fees, and the rationale for moving into these kinds of strategies, if you believe that capitalization weighted benchmarks in the US have done so well that we should apply some other information, analysis, methodology to try to generate incremental returns, because we don't think the capitalization weighted benchmarks can continue performing at this level. And that's at the risk of oversimplifying it, that really is the challenge.
It's just, sort of what's the overlap between some of the factors we already have actively managers like working on, like value, and then what we would, maybe move into kind of like a cheaper option of doing the same thing, just in a different way?
Well, in this fund, you have virtually no active management in the US market. So all those factors are present in the Russell 3000, but you don't have style-based managers, active managers in the pension fund.
Oh, in the pension fund? We
Yes.
do in the TDA.
Yes, but this is being considered for the pension fund.
Oh, not for the TDA.
Not at this
I mean, because
point,
we
yeah.
do have different styles.
In the
which,
TDA.
Which you're telling me today really is smart beta.
Well, what I'm telling you is it's factor-based. It's a
Factor-based,
factor.
right.
Yeah. Smart beta is just a marketing phrase.
Right, so in the TDA, we have style-based or factor-based active managers.
Yeah,
but
about
they're not
10%.
But they're not using this streamlined quantitative
Exactly.
approach.
So we could consider it if we found a compelling strategy. That would be
Yeah, I would
another.
one example though would be within the defensive strategies composite.
Yes,
There's
yes,
the-
that's a good point.
Yeah, they're low volatility strategies.
Right.
And volatility in this case is a factor that those managers are using to weight their portfolio or optimize their portfolio such that the overall portfolio has relatively less volatility compared to the broad market.
Yes, I had forgotten, that's a very good point. And we have 2 of those managers. And, you know, they approach low volatility factor investing in somewhat different ways. Their performance has been strong, generally strong, and actually at different points in time, one has outperformed the other. But let's say over 3 years, they haven't done as well. Over a longer period of time, they've generally kept up with the market. But
We don't expect them to keep up when the market's up 15%.
right. So those low vol managers were put into the defensive sector precisely because we thought they would protect on the downside, and that's the mandate for the defensive sector. So we have a pretty agnostic view on smart beta. We think there are some interesting products out there, but we think it should be considered as you would consider any active management strategy.
Just again on the QPP, I think that our U.S. equity is approximately 85% indexed, more than 85.
Yes.
So what we're thinking about is on the smart beta is just in that actively managed part, or taking some of the equity, some of the passive, and moving it to smart beta.
I believe
The latter.
Yeah, I believe the recommendation for TRS was 10% of the large cap index allocation.
We go to smart beta. 10%. That's pretty
decent chunk.
And you guys are agnostic on that?
Well,
I don't think they used air quotes.
That's we're not agnostic on the decision to make to do that. We're agnostic on smart beta versus traditional active. We think you would approach them in the same
Traditional
way.
active management.
Yeah.
But what about smart beta versus passive?
So there's obviously an incremental cost.
Yeah.
That's notable, particularly given the low base and what you pay today. But we do think it's an interesting way of kind of, if you believe that the equity markets have run quite a bit over the last few years, and if you think there's a way to sort of tilt away and not have to catch the falling knife that you might be forced to do if you're holding all cap weighted indices, this might be an interesting way of tilting away at this particular point in time. But you have to, again, do you have the same kind of belief and confidence in these strategies to outperform or protect the way you would any other active manager is the question. So.
And just to clarify, tomorrow is more of a discussion and
Education, I understand.
and then the following month, there was a smart beta search, and we'll be coming back with the results of that.
So we will be seeing, will we be seeing tomorrow some sort of data as to how certain factors are doing as compared to others so far, what them may or may not have been looking at, so that they are making this recommendation? Or is it,
I believe that the conversation, I think we could ask that, but the general presentation is just similar to this.
Just an
This is
overview.
what smart beta is. This is, how we're looking at it. This is why.
There is a presentation in the portal on their smart beta.
Yeah, I haven't looked at that.
It's pretty brief.
Okay, because I mean,
'Cause
if we're talking about thousands and thousands of different factors,
And I know
which,
that
which ones are we going with?
yeah, well,
Where
I assume that comes in the next month, but
right.
they
But I
do
think you should ask that.
the MSCI risk system. I think it has 3,000 factors or something like that you can disaggregate. For our current portfolio, and obviously can do that for prospective managers as well.
So again, what's being done here is, I think particularly by BAM, is an effort to say, how can we protect ourselves and what inevitably against what will happen inevitably? We don't know when, we don't know how. Can we protect ourselves? Can we protect these outstanding gains that we've generated? And And this is one avenue we should consider.
And the long duration treasuries was another, right?
Well, that's a very different, so that's a good point. So it's important to realize that just like any active management strategy, if the equity market declines significantly, the smart beta strategies will decline significantly. All your active managers will decline significantly. The hope is that they decline a little less. So these are marginal improvements. At the end of the day, what will drive the risk of your U.S. equity portfolio, no matter who's managing it, is the fact that you're invested in U.S. equities. And there's no escape from that. You can do a little better, you can do a little worse, but you can't get away from a market downturn. And that, so whatever we do, even if we move 10% of the large cap U.S. equity exposure, it can only have a de minimis impact on the total return of the total plan, because it's going to follow the U.S. equity market. Maybe we'll do a little better on that 10% of the large cap portfolio. It's a de minimis impact. The long treasury are an asset allocation decision, which could actually have a significant impact, because in a number of scenarios, when there are significant equity market downturns, there are actually significant gains in long treasuries. This doesn't happen every time, but there are a number of situations, most notably a flight to quality, in which that does happen. So that could have a very significant impact on total returns. I think there are many investors who are uncomfortable with long treasuries because they're concerned about rising rates and what will happen to long treasuries if rates continue to rise and rise significantly, which is a valid concern. But long treasuries could have a very significant defensive role to play in your portfolio. Smart beta would have a de minimis defensive role to play.
Is it fair to say that the decision about smart beta is more of a tactical decision, and the decision that we made about long treasuries in the last asset allocation was more of a strategic decision, or is that unfair?
I would say, I might use different words. I would say the smart beta strategy is an implementation decision. You know you want this much U.S. equity. How are we going to deploy it? The long treasury portfolio decision is an asset allocation diversification.
Yeah,
this is not diversification.
If you're going to call it a factor, that's more of a macro factor decision. You're trying to diversify the equity factor as a whole with interest rate exposure.
Just a question, you may not know the answer in it. During the month of February, when equity markets declined across the board, do you know what happened to long treasuries?
So long treasuries, this is one of those instances where we have seen treasuries actually move directionally with the equity market.
So they didn't protect.
So they didn't protect. They, I want to say at the trough of the recent period of volatility, when equities might have been down about 10% relative to their peak.
Yeah.
I believe long treasuries were down about 3%.
Okay, so
Magnitude, yes. But they didn't go up, yes.
Right.
You didn't see
and
the
partly you had this thing where interest rates
That's
are
right.
rising.
That's right.
So rising interest rates do often have a negative effect on equity markets, right?
Well, actually, I just calculated those statistics from another client yesterday, and less often than you might think. Less often than you might think. It's actually a relatively small percentage of the time. So, in 2008, you would have been very, very happy to have long treasuries.
Right, I know that was the justification.
Yeah, but it's not only 2008. It depends why equity markets are falling. If they're falling because of concerns about credit risk, long treasuries are going to do well in general.
Would it be a reasonable assumption that the downturn in February was so short, really just like a week or so, that there wasn't that flight for quality? Because by the time people had to process it, the markets were already turning back around?
No, I think it was really driven by concerns about inflation and rates rising.
Okay.
And that affected the equity market and the treasury bond market. And that may persist. So there are no guarantees, but to date, the best diversifier against equity risk is high quality fixed income.
Other questions or comments? Thank you for the presentation. Very informative. Sets a high bar for ban for tomorrow.
We collaborated together on this
Yes,
and that.
yes, we did
No
actually.
pressure, no
That's,
pressure.
we talked to them about this and we talked to them about their presentation and we wanted to make sure that they weren't to go through.
Okay, I think that concludes our public agenda. We do have an executive agenda, so a motion to move into executive session would be in order.
You've got it. I move pursuant to Public Officers Law, Section 105, to go into executive session for discussions regarding specific investment matters.
Thank you, Debbie. Is there a second?
Second?
Thank you, Susanna. Any discussion? All in favor of the motion to exit public session, enter executive session, please say aye.
Aye.
All opposed, please say nay. Any abstentions?
Yeah.
Motion carries. Okay, we're back in public session. Susan, would you report out of executive session, please?
Absolutely. In executive session, an issue with our custodian was discussed.
Thank you. I think that concludes our business for today. A motion to adjourn would be in order.
So moved.
Is there a second?
Second.
Thank you. Any discussion? All in favor of the motion to adjourn, please say aye.
Aye.
All opposed, please say nay. Any abstentions? Motion carries. Thank you very much.
Thank you.
Thank you.